Part 1. Who they are. 20 giants in 3 categories. Group 1. Masters of the Legacy. 1. Walton Enterprises, Walmart. Originating from the wealth of founder Sam Walton, this is the world's largest family office. It acts as the core hub, supporting the family's wealth by controlling approximately 50% of Walmart's outstanding shares. They employ a hub-and-spoke model where the central entity oversees tax, legal, and baseline asset allocation, while operating 3 independent satellite offices tailored to individual family members' preferences. Specifically, these consist of the Walton Investment Team, Public Equities and ETFs, Builder's Vision, Impact Investing, and Madrone Capital Partners, late-stage private equity and energy tech. They mitigate tax risks through a tax control structure that separates voting rights from economic interests. Moving away from a passive stance of merely entrusting capital, they enforce co-investment rights in top-tier companies and directly intervene in deal structuring. 2. Ponte Gadea Inversiones, Zara. Built on the wealth generated by the Zara fashion empire, Ponte Gadea employs a strategy of funneling the massive cash flow earned from fast fashion into the most stable and heavy assets, global core commercial real estate and infrastructure. They strictly exclude highly volatile residential real estate, aggressively purchasing only prime commercial buildings in major metropolises like New York, London, and Madrid to build a robust downside defense. Recently, they have expanded beyond simple real estate rental income, diversifying their portfolio into telecom infrastructure, renewable energy, and power grids. Through this ruthless capital allocation strategy, they aim to lower correlation with their core textile business and ensure the perpetuation of their wealth. 3. Moose Partners, Chanel. Managing the assets of the global luxury brand Chanel and the Wertheimer family, Moose Partners executes top-secret investments on a global scale from its New York headquarters. Despite their luxury background, they are characterized by highly aggressive and pioneering investments in venture capital, private equity, healthcare, biotech, and IT. Led by Charles Heilbronn, the office aims for intergenerational wealth preservation through institutionalized investing, consistently participating in major funding rounds for trendy tech companies like Kava, Bird, and AI Foundation. Notably, rather than entrusting funds to blind pools, they seized the main sponsor position in venture and late-stage IT deals, directly driving the deal structure. 4. Waycross, Cargill. Managing the assets of global agricultural giant Cargill and the Cargill-Macmillan family, Waycross was established in 1991. It internalizes multi-generational inheritance governance and tax policy advocacy to solidify the family's control. Unlike typical family offices, they execute these core functions directly, without external outsourcing. On the investment side, they build an omnidirectional portfolio encompassing private equity, real estate, hedge funds, and infrastructure. Leveraging their background in agriculture, they are deeply involved in agricultural infrastructure deals, preferring buyouts and commodities, thus executing a strategy closely tied to the family's business roots. 5. Woodbridge Company, Thomson Reuters. As the private holding company of the Thomson Reuters media family, Woodbridge holds a controlling stake in the multinational information services company, Thomson Reuters, and Canada's top daily newspaper, The Globe and Mail. They spearheaded the radical transformation of the empire, from Roy Thomson's traditional media group into a financial data, legal information, and risk management platform. Despite the high volatility of the media industry, they maximized cash flow by pivoting to B2B data services. This stands as a prime example of how legacy capital can survive by adopting a modern business structure. 6. Edizione, Benetton. Originating from the Benetton clothing brand, Edizione has evolved far beyond simple wealth management, transforming into one of Europe's premier infrastructure holding companies. They completely shifted their initial capital into transportation, digital, and financial infrastructure. They hold a majority stake in Mundys, which controls airports and highways, and have also secured stakes in Cellnex, Europe's largest wireless telecom tower operator, Avolta, a global duty-free leader, and Assicurazioni Generali, a massive financial institution. Shifting capital from the declining fashion consumer sector into essential national infrastructure is considered the most overwhelming winning move executed by legacy capital. 7. Fedesa, Ferrero. Managing the assets of the Ferrero chocolate family, Fedesa was established in Monaco in 2016. Though relatively young in its structure, the sheer volume of its AUM ranks among the global top tier. Rather than simply parking capital in safe assets, they exhibit the traits of an active fund manager, identifying undervalued, high-quality assets and generating profit through restructuring or value enhancement. Proficient in value investing and turnaround strategies, they play a crucial role in permanently preserving and expanding the family's wealth through aggressive investment activities. 8. Kirkby, Lego. The parent company of the Lego Group and the Kirk Christiansen family, Kirkby holds major stakes in Lego and Merlin Entertainments. They manage their capital by strictly dividing it into core capital and thematic capital. Core capital ensures stability through blue-chip public equities and real estate investments in Switzerland and Denmark, while thematic capital is aggressively allocated to future-oriented businesses that reflect the family's philosophy, such as renewable energy and plastic alternatives/recycling tech. Having recently completed a successful leadership transition, they represent the most exemplary direction of generational shifts and ESG investing among legacy families. Group 2, the Tech Disruptors. 9. Accession LLC, Elon Musk. Originating from Tesla and SpaceX, Elon Musk's capital vehicle, Accession, is known in the market as an innovator, but from a capital structure perspective, it operates closer to an extreme leverage engine. Instead of relying on dividends, they raise capital by executing massive margin loans backed by Tesla stock. As seen in the Twitter buyout, they bypass the rigorous due diligence or downside protection required by traditional private equity. Instead, they deploy near-infinite permanent capital directly into deep tech companies with zero initial cash flow, such as SpaceX, Neuralink, and xAI. Through this, they structurally subjugate large venture capital firms, which are constrained by fund maturities, and perfectly vertically integrate and control the value chain of future industries. 10. Cascade Investment LLC, Bill Gates. Originating from Microsoft founder equity, Bill Gates's Cascade serves as a textbook example of macroeconomic infrastructure privatization designed to hedge against single asset concentration risk. The massive cash generated from tech assets was poured into purchasing the largest swaths of farmland in the U.S. They completely transitioned their portfolio into irreplaceable real assets, such as a controlling stake in Four Seasons Hotels and waste management firm Republic Services. This structure ensures permanent rent-seeking capabilities even if the macroeconomy collapses, making it a case where tech capital has built a robust downside protection structure most similar to the legacy capital in Group 1. 11. Bezos Expeditions, Jeff Bezos. Funded by wealth generated from Amazon, Jeff Bezos's family office is a powerful tool designed to bypass public board scrutiny and complete the founder's private worldview. Every year, billions of dollars from stock sales are injected directly into ultra-long-term, ultra-high-risk projects, like the space venture Blue Origin and the anti-aging biotech firm Altos Labs, that Amazon's public shareholders would never approve. Unlike traditional venture investments, they are not bound by exit clauses or internal rate of return (IRR) hurdles. By acquiring the Washington Post, they have also internalized political leverage, reigning as a perfect private control mechanism. 12. Ballmer Group, Steve Ballmer. Built on massive Microsoft dividends and stock, Steve Ballmer's office is a prime example of how acquiring giant sports franchises serves as a massive tax avoidance vehicle. Purchasing the LA Clippers for $2 billion and personally building the Intuit Dome was not merely a hobby. It exploited structural loopholes in the U.S. tax code. By aggressively amortizing the sports team's intangible assets, like player contracts and broadcasting rights, over 15 years, they executed an extreme tax optimization deal that legally offsets the astronomical dividend income taxes generated from their core holdings. 13. Bayshore Global Management, Sergey Brin. Originating from Google's founding equity, Sergey Brin's Bayshore is a highly secretive office established to perfectly shield capital from the strict ESG regulations and shareholder activism of public companies. It supplies unlimited private capital to disruptive and highly unconventional tech projects that the core Google entity could not underwrite. Notably, they completely reject the traditional 2 and 20 fee structure associated with entrusting capital to venture funds, operating instead as unregulated risk, capital exercising absolute private control, free from external interference. 14. DFO Management, Michael Dell. Based on stakes in Dell Technologies, Michael Dell's family office is an apex predator in the ecosystem, representing an evolution where a personal wealth management vehicle transforms into a massive private equity firm itself. Since its days as MSD Capital, it directly inserted the majority shareholders' personal capital into the top-tier equity of the historic $67 billion Dell EMC buyout. Going beyond simple investing, they issue their own private debt, purchase leading global prime real estate, and act as their own general partner, GP, rather than committing to external funds, effectively writing the rules of the global alternative investment market. 15. Emerson Collective, Laurene Powell Jobs. Based on inherited assets from Apple and Disney, Laurene Powell Jobs' Emerson Collective represents the ultimate form of regulatory arbitrage in the global capital market. To bypass the legal restrictions of traditional 501c3 nonprofit foundations, which must mandatorily disburse 5% of their net assets annually, they adopted an LLC structure. Through this structural decision, they completely broke the shackles of capital, simultaneously conducting philanthropic activities, for-profit high-yield venture investments, acquisitions of influential media like The Atlantic, and unlimited political donations all under one roof. 16. Wayborn Group, James Dyson. Generated from the Dyson hardware empire, James Dyson's Wayborn Group illustrates how manufacturing-based new money meticulously manages real estate and tax havens to facilitate intergenerational wealth transfer. In stark contrast to Dyson's cutting-edge tech innovations, they aggressively purchased massive tracts of agricultural land in the UK. This was a highly calculated structural bet aimed at the 100% inheritance tax exemption via agricultural property relief under UK tax law. Furthermore, they operate a sophisticated capital allocation strategy, flexibly shifting their family office hubs between Singapore and the UK to legally bypass the radar of global tax authorities. Group 3. Sovereign and Regional Mega Capital. 17. Dubai Holding, originating from Dubai's sovereign assets and core commercial infrastructure, real estate, logistics, telecom. Dubai Holding is perceived by the market as a massive real estate developer or investment holding company. In reality, it boasts a structure where state power and private capital are perfectly hybridized. The legal hurdles, such as permitting and antitrust reviews, that traditional private equity faces when structuring infrastructure deals are meaningless here, because the buyer deploying the capital and the ultimate licensing authority of the region are the exact same entity. Through this sovereign immunity, they arbitrarily control deal precedents and utilize the near-infinite rent generated from national infrastructure as an equity cushion, creating an asymmetrical leverage that distorts the cost of external capital. 18. Al Nahyan Family Office. Backed by Abu Dhabi's oil capital, the Royal Group, and sovereign wealth fund-linked assets, the Al Nahyan royal family's office pursues a strategy of forced synchronization with the Western value chain, rather than merely chasing returns. Weaponizing their massive oil wealth, they are buying up the essential backbones of Western economies outright: English Premier League clubs, European telecom infrastructure, and core US AI data centers. Beyond financial motives, this is the most extreme form of downside protection, establishing a mutual hostage structure where, in the event of geopolitical risks or Western sanctions, they can trigger a macro paralysis of the Western economy in reverse. 19. Hartono Family Office. Originating from the Jarum Tobacco Empire and Bank Central Asia, Indonesia's largest private bank, the Hartono family acts as a macroeconomic tollgate that global private equity firms must pass through to enter the Southeast Asian market. They control BCA's massive liquidity, like private property, effectively monopolizing the local cost of capital. Their deal structures are strictly subordinated to maintaining their domestic financial and retail cartels, rather than improving the fundamentals of target companies. Consequently, for foreign venture capital or infrastructure funds to invest in this region, a structural dependency occurs where they must integrate into the funding rounds designed by the Hartonos and accept their monopolistic rent extraction. 20. Indorama Capital Holdings. Based on Indorama Corporation, a global petrochemical and essential commodities company, the Lohia family's office is a landmark real asset capital that has privatized continental-scale essential supply chains. When global PE firms structure deals in the chemical or consumer staples value chain, the Lohias leverage their formidable dominance over core raw material supply chains to directly intervene in deal conditions. Part 2. The Mechanics: Restructuring Control and Dismantling Constraints. The fundamental reason the global top 20 family offices reign supreme in the alternative investment ecosystem is not simply the sheer size of their capital. Instead of being subordinated to the fee structures of blind funds, they completely neutralize or redesign the legal and financial constraints of traditional PE/VC deals to match the nature of their own capital. Their operational mechanics are deconstructed and analyzed across two axes: deal structuring and capital constraints. 1. Deal structure. Breakdown. Dismantling the SPA and seizing control. The three groups leverage their unique capital characteristics to force closing conditions precedent, or completely bypass them, exerting structural control. Group 1. Masters of the legacy. The most critical legal constraint mechanism in managing legacy capital is the strict separation of control and economic interest. To defend against tax risks, they control governance centrally while sourcing deals through subsidiary offices. Furthermore, when forming funds with mega PEF managers, they use their massive capital power to force new conditions. They have moved past merely demanding fee-free co-investment rights, which waive fees upon simple capital commitment, to actually reversing the ratio, where their direct investments, where they dictate the deal structure, surpass their blind fund commitments. Group 2. The tech disruptors. The core legal and financial constraint governing the deal structures of tech, new money, is single asset concentration risk. Because selling shares triggers tax leakage and weakens control over their public entities. They raise capital by executing massive margin loans against their stock. Thus, all their investment activities are absolutely subordinated to financial covenants, maintaining the stock price of their core entity and the loan-to-value LTV ratio, rather than complex deal precedents. Rather than designing sophisticated exit clauses, they prefer intuitive and forceful deal sourcing, leveraging their overwhelming collateral power to buy out entire initial funding rounds or monopolize the main sponsor position. Group 3. Sovereign and regional mega-capital. Deals led by sovereign-level family offices neutralize the very framework of traditional share purchase agreements, SPA. The antitrust and fair trade reviews required for standard M&A closings become meaningless, as they are simultaneously the buyer injecting capital and the ultimate authority approving the regulations in that region. Instead of playing by rules made by others, they rely on regulatory immunity and cartel-like dominance to directly design and control the conditions precedent of their transactions. 2. Capital constraints, breaking duration limits, and asymmetrical leverage. A stark contrast emerges when comparing how these entities deploy near-infinite permanent capital versus typical funds bound by 10-year maturities and IRR hurdles. Group 1. Maximizing downside protection. Under global macro volatility, legacy capital prefers tranche designs that fundamentally block the loss of permanent capital. Recently, they have raised their private debt allocations to 4%, preempting the safest position as senior secured creditors in the capital structure. They execute ruthless capital allocation, flipping the illiquidity constraint of assets into a weapon for inflation hedging and permanent monopoly rent collection. Group 2. Infinite duration. Betting on the power law. Paradoxically, their greatest weapon is the absence of maturity. They manage permanent capital with near infinite duration. Structural constraints that would bankrupt a normal institutional investor who cannot withstand the J-curve effect are offset by the appreciating stock value of their underlying public companies. Foregoing traditional downside protection, they run an extreme form of venture capital, betting their entire capital structure on the power law, where a few winners monopolize all the market spoils. Group 3. Asymmetrical cushion and tail risk. The sophisticated cost of capital constraints of typical buyout deals do not exist for them. At the very bottom of their equity lies a near-infinite cushion composed of sovereign credit and monopolistic rent income. However, their capital deployment is not governed by fund life cycles or IRR hurdles, but is absolutely subordinated to political incentives like geopolitical hedging. Therefore, while overwhelming in peacetime, they structurally harbor a fatal tail risk where a macroeconomic shock could freeze their entire capital network. Part 3. The Precedents. Cycle of redefining market rules. While capital of the past merely tracked market returns and established models, today's mega-family offices are dismantling existing financial precedents and reassembling the investment landscape in their favor. Breaking away from the dominance of blind funds to reign as rule-setters, their contrast with historical precedents is analyzed across 3 axes. 1. Structure. Comparison. Severing traditional financial models and forcing dominance. Group 1. Masters of the legacy. Until the early to mid-2000s, many single-family offices blindly followed the Yale model, the textbook for asset allocation, remaining passive LPs allocating capital to private equity blind funds. At the time, they were completely subordinated to the high 2 and 20 fee structure unilaterally designed by GPS. Today, however, mega legacy capital weaponizes its immense scale. In exchange for anchoring mega GP funds, they enforce fee-free co-investment rights as the top priority clause in their contracts. This is a structural shift that eliminates the information asymmetry of blind funds and secures the control needed to directly intervene in the financial covenants and governance of individual deals. Group 2. The tech disruptors. Traditional Silicon Valley venture capital and late-stage private equity are bound by structural shackles, a 10-year fund life, and a hurdle rate around 8%. This forces them into a cycle where, upon maturity, they must push for premature IPOs or secondary sales, regardless of the target company's fundamentals. Tech. New money, however, is permanent capital with infinite duration and zero such constraints. When structuring club deals, instead of demanding complex liquidation preference tranches, they demand key board seats and access to the target company's technical data. They are establishing an entirely new precedent that prioritizes industrial control for ecosystem integration over financial safety nets, designed to defend short-term IRR. Group 3. Sovereign and regional mega-capital. In the past, Russian oligarch family offices that accumulated massive wealth remained as passive LPs, depositing capital into private banking or the blind funds of mega-PE firms within the Western financial system. Relying solely on political connections without controlling the backbone of core infrastructure, they left a fatal precedent where their assets were immediately frozen or confiscated during geopolitical crises. Today's mega-capitals have thoroughly learned from this. Rejecting passive deposits, they execute highly sophisticated geopolitical deal structuring by outright acquiring irreplaceable landmark assets, such as English Premier League clubs, essential European telecom networks, and core U.S. deep tech firms, embedding their private property irreplaceably into the cogs of Western capital structures and the global macroeconomy. 2. Downside protection test. Defense mechanisms and limits. During crises. Group 1. Masters of the legacy. 2 major stress tests. The 2008 global financial crisis and the rapid interest rate hikes of 2022 pushed legacy capital's downside protection logic to an extreme evolution. Reacting to the historical precedent where LPs tied to pure equity funds suffered severe liquidity squeezes from capital call pressures and portfolio markdowns, they aggressively shifted their positions to private debt and senior secured loans to seize top priority in repayment during bankruptcies or defaults. Excluding highly economically sensitive equities or VC, they solely acquire strictly LTV-controlled prime offices and essential infrastructure. By physically holding monopolistic real collateral, they have built a perfect downside defense network that passes losses onto others even during extreme market shocks. Group 2. The tech disruptors. The most painful precedent of a high-risk, single-asset concentrated leverage structure collapsing was the Archegos capital margin call disaster of 2021. The extreme leverage built via total return swaps and margin loans was utterly annihilated during a short-term dip in the underlying stock. However, tech disruptors offset this lack of traditional downside protection with the power law. Even if 9 out of 10 deep tech investments go bankrupt, they execute bets where a single core investment generates an asymmetrical upside of thousands of times, covering the entire portfolio's losses. Their true downside protection is not a sophisticated put option contract, but the sheer market capitalization and overwhelming cash-generating power of their underlying public entities like Amazon, Microsoft, and Tesla. Group 3. Sovereign and regional mega-capital. In standard private deals, downside protection is achieved through put options, tag-along rights, and senior collateralization. For mega-capital, where sovereign wealth and private property are intertwined, the ultimate downside protection is state-to-state diplomatic leverage itself. Even if a target company faces a crisis, they compensate for the loss by pressuring governments to deregulate or extend monopolistic licenses. However, there is a fatal blind spot, an extreme tail risk stemming from a complete lack of governance. The prime precedent is Malaysia's 1MDB scandal, mixing public sovereign funds and private capital without internal controls to generate leverage led to the collapse of the entire capital network after a single political regime change and global money laundering probe. Their downside protection is thus perfectly subordinated not to financial limits, but to the limits of their political lifespan. 3. Ripple effect. The power realignment of the alternative investment ecosystem and the extinction of middlemen. Group 1. Masters of the legacy. The mass exodus of legacy capital from blind funds toward direct investing is causing a painful ripple effect across the entire PE value chain. Even the highest-tier global mega GPs are caught in a dilemma where they must surrender equity allocations from their most profitable deals via co-investments just to attract this capital. Paradoxically, this dilutes the return of the main fund, creating structural reverse discrimination that harms ordinary institutional investors or smaller LPs. More fatally, this leads to the downfall of middle-market GPS, who lack the capacity to offer such structural benefits. The alternative investment market is undergoing a complete power shift from managers who intermediate capital to the mega family offices that are the sources and architects of that capital. Group 2. The tech disruptors. The direct investment trend of super new money is vertically restructuring the VC ecosystem value chain. In the past, mega VCs monopolized deals from the early stages right up to pre-IPO. Now, in deep tech rounds requiring billions of dollars, such as AI foundation models or aerospace, they must surrender the lead investor position to tech billionaires' family offices. Consequently, VCs constrained by fund sizes are reduced to subcontractors, dependent on the billionaires' capital injections. Furthermore, as these mega capitals monopolize the growth of promising startups entirely within private markets, a structural exploitation environment is solidifying where public retail investors are left holding the bag, only able to buy shares after growth has stagnated or valuations have maxed out. Group 3. Sovereign and regional megacapital. The heavy tilt toward direct investments by regional megacapital and ruling families is shaking the power dynamics of the global alternative investment ecosystem to its core. Even Western mega GPS like KKR, Blackstone, and Carlyle are now desperate to form club deal partnerships with these families, rather than relying on independent fundraising just to close core infrastructure deals in the Middle East or Asia. Effectively, top-tier global managers have been reduced to deal-sourcing subcontractors, assisting the massive asset allocations of this sovereign capital. Furthermore, when families controlling national grids and finance dominate the market, a complete subjugation of the local value chain occurs as local competitors fail to overcome the gap in capital costs and die out. Ordinary minority shareholders and subordinated investors are left as passive subjects, forced to permanently pay the rent set by these megacapitals within the monopolistic licenses and regulatory barriers they have engineered. Part 4. The incentives. Perpetuation of the empire. The aggressive capital allocation of global top-tier family offices cannot be explained merely by the maximization of returns or the extravagance of surplus capital. Their deal sourcing and structural control are driven by powerful, predatory incentives designed to overcome the inherent limitations of their capital and ultimately perpetuate their empires. We analyze the structural pressures under which each group operates and what the final evolutionary form of the alternative investment ecosystem they will dominate will look like. 1. Player incentives and what if. Hidden motives and structural inevitabilities. Group 1. Masters of the legacy, generational transition pressure, and the talent black hole. The struggles of legacy families are driven by a singular goal: the perpetuation of the empire. Over 60% of these top 8 family offices are facing massive leadership transition events within the next decade. As founders or second-generation leaders step down, the most fatal risk is the fragmentation of capital due to intra-family factional politics and unprofessionalism. To defend against this, they have a powerful incentive to perfectly institutionalize themselves, driven by a conservative paranoia. By offering near-infinite permanent capital to exhausted partner-level fund managers, they act like a black hole, sucking in core talent from global private equity and investment banks to internalize top-tier deal sourcing networks and financial structuring capabilities. If they fail to build this institutionalized direct investment system, their scattered capital will become the target of punitive taxation across various nations, or be reduced to passive liquidity providers. Thus, securing deal dominance is a structural necessity for survival. Group 2. The tech disruptors. Bypassing public regulation and completing the private worldview. The ultimate purpose for tech disruptors. Locking massive capital into private family offices is to perfectly privatize the next infrastructure of humanity, escaping the public markets full of shareholder activism, ESG regulations, and short-term performance pressures. Within their public entities, they face strict surveillance from boards of directors and the SEC, but within the regulatory blind spot of a family office, they mutate into entirely different predators. Had they pursued space exploration or artificial general intelligence, AGI, development, using public R&D budgets or traditional VC funding, the projects would have been stranded early or sold off prematurely due to quarterly earnings pressures and LPs demanding liquidity. Armed with infinite capital, they follow a strategic incentive to bypass traditional governance and build their own monopolistic ecosystems. Group 3. Sovereign and regional megacapital. Regime survival and the completion of the mutual hostage structure. Their extreme deal sourcing is both a process of setting up geopolitical collateral against macroeconomic threats and a means of maintaining power. The fundamental incentive for these regional monopolistic players to pour astronomical capital into core Western infrastructure lies in geopolitical hedging. If they simply parked their surplus cash in domestic real estate or Western public equities, they would take an immediate hit or have their assets frozen in the event of an oil price crash, emerging market currency crisis, or Western political sanctions. By embedding their private property deep into the heart of Western capitalism, they are meticulously engineering a mutual hostage structure. If the West attempts to sanction or confiscate their assets, the economic infrastructure of the Western nations themselves will inevitably be paralyzed. 2. The endgame, the final evolutionary form of the capital ecosystem. Group 1. Masters of the legacy, the extinction of middlemen, and direct deals among mega-capital. Ultimately, these shifts are highly likely to culminate in the extinction of intermediaries in the alternative investment market. Mega-family offices managing hundreds of billions of dollars no longer have any reason to hand over management and performance fees to GPs under the pretext of information asymmetry. The future ecosystem will polarize into a closed league where middle-market GPS unable to raise capital are thoroughly wiped out, while mega GPS with massive proprietary capital and sovereign-level family offices directly form club deals with one another. They will fully reign as architects who directly control global prime real estate, core infrastructure, and high-yield private debt to dictate the rules of the market. Group 2. The tech disruptors. Building closed-loop ecosystems and complete vertical integration. The flow of their capital will ultimately lead to the total privatization of innovative technologies and the construction of closed-loop value chains. By injecting capital into target companies while practically forcing them to use the cloud infrastructure owned by their core public entities, they form a perfect hedge ring where a significant portion of the startup's cash burn flows right back as revenue to their main corporation. In the end, they will reign as state-level venture monopoly capitals, controlling every step on their chessboard, from the initial seed stages of the deep tech market through infrastructure provision all the way to final M&A exits. Group 3. Sovereign and Regional Mega Capital. The normalization of G2G deals and reigning as the lender of last resort. The flow of capital is highly likely to lead to the nationalization of private markets. When global interest rate cuts are delayed and macro recessions plunge Western landmark companies or mega GPs into liquidity crunches, these sovereign-level family offices will step onto the field as the market's sole saviors and lenders of last resort. Multi-billion-dollar mega infrastructure deals will transform from competitions among private equity firms into state-to-state G2G negotiations between mega families and Western governments. They will continue their predatory expansion by exploiting periods of valuation decline to forcefully incorporate the most structurally advantageous tranches at fire sale prices.